Hey guys, welcome back to another episode. In this video, we will be showing you the #1 trading strategy that combines Fibonacci with price action. This will be the most important trading video you will ever watch, as we'll be covering concepts you won't find anywhere else online. Whether you trade stocks, options, cryptos, or currencies, this price action video is essential for all traders of all asset classes. We're also going to go through the massive Bitcoin and crypto trade our members and us gained on using this exact strategy so that you can do it yourself. Now, if you want us to release more videos more often, please click the like button, subscribe, and turn on the notifications bell so that you know exactly when we release new content. Now, here's a quick breakdown of what we will be covering in this video. So let's get right into it. A topic we get asked to cover almost daily is how to use Fibonacci in trading. As you already know, we always read the comments to decide what topics to cover next. So right now, go to the comments section and tell us exactly what topic you want us to cover next. When we say Fibonacci, we are referring to the Fibonacci tool and Fibonacci levels. So why is the Fibonacci tool and Fibonacci levels important to use and understand? The Fibonacci tool provides you with trade entry opportunities at areas of value during a moving trend, as Fibonacci levels can act as a form of key support and resistance. And as you should know by now, support and resistance levels are areas where price has a high chance of reacting to or reversing from, all which again create high quality trade entry opportunities for you. Let's now access the Fibonacci tool. To access the Fibonacci retracement tool, click this button here on the left. Scroll down and click Fib retracement right here. Now to use it, click on the chart, drag the tool upwards, and then click again to lock it in. Then to the right, your Fibonacci retracement levels will appear. Now these levels are important because they are the most widely used Fib levels by traders and represent areas of value within a moving trend. So let's go through how to apply the Fibonacci tool right on the charts. Let's say you're analyzing this current moving uptrend. You have your run, pullback, run, pullback, run. As you already know, an uptrend makes higher highs and higher lows. So if you are analyzing this run here and want to apply the Fib tool to find areas of value to enter trades long at, here's how it works. You grab your Fib tool, click where the swing low is at the bottom of the wick, drag the tool to the top of the moving trend and where the swing high is. You will then see the Fib level percentages appear to the right. If price were to pull back to the 50% level, this would represent a pullback of 50% from the recent swing high here. And if price were to pull back to the 61.8% level, this would represent a pullback of 61.8% from the recent swing high here. So let's show this in the opposite direction and in a downtrend. You have your run, pullback, run, pullback, run. As you already know, a downtrend makes lower highs and lower lows. So if you are analyzing this run here and want to apply the Fib tool to find areas of value to enter trades short at, here's how it works. You grab your Fib tool, click where the swing high is at the top of the wick, drag the tool to the bottom of the moving trend and where the swing low is. You will then see the Fib level percentages appear here to the right. If price were to pull back to the 50% level, this would represent a pullback of 50% from the recent swing low here. And if price were to pull back to the 61.8% level, this would represent a pullback of 61.8% from the recent swing low here. Now, how do average traders traditionally use Fibonacci to enter trades? So in an uptrend, when price pulls back to these fib levels, traders will enter trades long when price hits these fib retracement levels, because Fibonacci levels act as a form of support in an uptrend. And again, support levels are areas where price can potentially bounce and reverse from. Going the other way, in a downtrend, when price pulls back to these fib levels, traders will enter trades short when price hits these Fibonacci retracement levels, because Fibonacci levels act as a form of resistance in a downtrend. And again, resistance levels are areas where price can potentially bounce and reverse from. Now, let's get into the psychology of Fibonacci and why Fibonacci levels work. So the first reason Fibonacci levels work is because of herd mentality, or what can be deemed a self-fulfilling prophecy. A lot of traders subscribe to these fib levels in order to identify trade opportunities. To be more specific, the school of Fibonacci traders who look to take action at fib levels adds additional confluence to areas you are already watching for trade opportunities. And we'll dive deeper into this in the next section. And the second reason Fibonacci levels work is because Fibonacci levels actually represent areas of value during a moving trend. Or more specifically, you're getting in at a better price relative to where price has already been. So, how do we use Fibonacci as part of our trading? First, let's go through the exact fib levels we use and the quality of the different Fibonacci levels. First, the 50% or 0.5 fib level. This is a great quality fib level as it represents a deep pullback during a moving trend. As a quick note, even though we say level, you should treat it as an area, like all things. Second, the area between 50% fib and 61.8% fib. This is again a great quality fib area, as it represents a deep pullback during a moving trend. And third, the 61.8% or 0.618 fib level. This is the best and highest quality fib level because it represents a very deep pullback and best area of value during a moving trend. Now, there is a problem that lies with using Fibonacci levels the traditional way. When price pulls back to a fib level a trader subscribes to using, they will enter a trade instantly once price hits the Fibonacci level, as they expect price to reverse. Now, the problem with using fib this way is that you're assuming that price will reverse solely because it is at a fib level, and not take into account the multitude of other moving parts within a noisy and imperfect market. Fibonacci levels do indeed work as support and resistance levels, but Fibonacci levels on their own isn't enough. So this then leads us back to the main question we get asked, which is, how do we use Fibonacci as part of our trading process where it actually helps? Here is the exact formula we use. We combine Fibonacci levels with key levels of support and resistance, or areas of confluence, to increase trade quality. Now, this is a stacked statement, so let's break it down, starting with combining Fibonacci levels with key levels of support and resistance to increase trade quality. First, let's quickly recap what key levels of support and resistance is. Key levels of support and resistance are levels where price has reacted to, bounced from, or reversed from in the past. This matters because if price reacted to these levels in the past, there is a chance that price will react to them again in the future, meaning possible trade opportunities arise at these levels. Now, back to the first way we use Fibonacci, which is combining Fibonacci levels with key levels of support and resistance to increase trade quality. So let's do this right on the charts, but from our perspective at every step. You had your key level of resistance here, so you would have had it drawn in and extended out in case price reacted to it again in the future. After price broke out, this key resistance level then becomes new support, which means if price approaches this level, there are possible trade opportunities long. So how do we increase the trade quality of this trade opportunity? This is where the Fib tool comes into play. With the Fib tool, click at the swing low here, drag it up to the recent swing high, and look at that. The trade opportunity you identified is also right at the 61.8% Fib retracement level, which is a very high quality Fib level, as it represents a very deep pullback within the moving trend and a great area of value to get in at. So the combination of a key support level with a key Fib level increases the quality of the trade opportunity, instead of taking a trade with only a support level. Now, as price approached this level of support, you had no idea whether there would be a reaction to the level or not. You needed to wait for price action through candlestick formations at the area to show that price is indeed reacting to the level this time around. So when price reached the level, you had exactly that, which was a candle with a long wick sticking out, which shows a reaction to the level and confirms the trade opportunity long. So let's build on this and move on to the next way we use Fibonacci, which is combining Fibonacci levels with areas of confluence to increase trade quality. So first, areas of confluence are areas where multiple schools of traders are stacked and looking to take action, which presents trade opportunities. These trade opportunities at these areas of confluence, where many schools of traders are stacked, have a higher probability of going in your favor due to many traders taking action at the same time, which creates momentum for the trade. This here is where the short trade opportunity occurred, as it is an area of confluence and access point. So let's break it down. First, you would have identified this as a clear moving downtrend, as price is making lower highs and lower lows. So you want to trade with the moving downtrend. You had your key level of resistance here because of this reversal point. You have your trend line here, and because it crosses with the resistance level, it makes it an area of confluence. You then have your moving average here. Notice how it intersects perfectly at the access point and area of confluence. So to increase the quality of the trade, we grab the Fib tool, click at the swing high here, drag it down to the recent swing low, and look at that. The trade opportunity you identified at the area of confluence is also at the 50% Fib retracement level. So when price reached the level, you had multiple long wick candles sticking out and failing to break through, which shows a reaction to the area of confluence and confirms the trade opportunity short. So why is this a high quality short trade at this area of confluence? You had support and resistance traders looking to enter short. You had trendline traders looking to enter short. Moving average traders looking to enter short. Trend traders looking to enter short. Candlestick and price action traders looking to enter short. Confluence traders looking to enter short. And then also you had Fibonacci traders looking to enter short. All these schools of traders stacked at the area of confluence looking to take action, and in this case, take action and enter short trades increases the chances of the trade going in your favor, which means it is a high quality short trade entry. Before we get into the strategies section, there is one topic and foundational trading ideology you must learn first. It is the concept of trade quality. Without fully understanding trade quality, your trading journey ends here and you will always be at a huge disadvantage. This is the most important trading lesson you will ever learn. So before we continue, at our office, stored on our servers, we have a series of advanced, high-quality trading videos already completed, ready to be uploaded to YouTube. Now, the only way we'll release them is if enough of you do the following. First, hit the thumbs up button on this video. Second, hit the subscribe button. Third, hit the notifications bell. Fourth, leave a comment below with exactly what video topics you want us to cover. And 5, the most important one, go follow our Instagram page, which is Wysetrade. And the link is also in the description below this video. All right, let's get back into it. So what is trade quality exactly? Any attributes and factors that influence the chances of success of a trade opportunity you have identified. Meaning, you shouldn't look at trading as taking right or wrong trades, but you should look at trading as taking low quality trades versus high quality trades. So how do we increase the quality of a trade? Simple. The more you learn and understand about price action, the more high quality traits you can identify. The more high quality traits means the higher the probability it will go in your favor, but more importantly, go in your favor with true momentum and distance so that you can actually make a good return on the trade. So here it is, the most important part. We're now going to go through a list of high quality traits. The more you have from this list within a trading opportunity you have identified, the higher the trade quality. Every example in this video will be coming back to reference this list. First, trend trading. Are you trading with the moving trend? In an uptrend, you would want to look for long trade entries to move with the flow of the upwards market pressure. In a downtrend, you want to look for short trade entries to move with the flow of the moving downwards market pressure. Next, breakout momentum. Are you trading with heavy breakout momentum? So what you do is you identify a key level of support or resistance where price tried multiple times to break through and failed. Then price finally broke through the level, showing the heavy bullish momentum and heavy buying presence that entered the market. So from a price action perspective, for price to be able to break such a key level that held multiple times, there needed to be heavy momentum that entered the market. So what you want to do is trade with the heavy bullish momentum and buying presence so that you can ride the wave. Next, a fresh trend versus trend exhaustion. Are you getting into a trade at the start of a reversal and a fresh trend where price has legs and room to move? Fresh trends and fresh reversals are powerful because you can capture a larger portion of the move as you are getting in early and at the start. In contrast, when you enter trades after the trend has already moved significantly, the trend might suffer from trend exhaustion, and if enough people start taking profit, it can trigger a larger reversal. Next, using the higher timeframes. Things you find on the higher timeframes hold more weight. When we say higher timeframes, we are referring to the monthly and weekly timeframes specifically. So what exactly is things you find? It can be key levels, price movement, price patterns, or any form of price action that is visible on the higher timeframes that influences your directional bias. Price action takes longer to form on the higher timeframes, but as a result, it gives you a more accurate depiction of where price is headed and of what the market is actually doing. Next, multi-timeframe usage and timeframe confluence. Do you have timeframe confluence, meaning using multiple timeframes that give you the same directional bias? We'll cover this in an upcoming video. Next, divergence. Remember in our previous video, divergences can be very effective in gauging possible reversals of price and reversals of the trend. So here's a chart we showed you in our last video, showing the different qualities and types of divergences we look for. Again, reference our last video on RSI where we covered divergences in depth. Next, Fibonacci retracement levels. Are you at a fib level? And if so, which fib level? Are you combining Fibonacci levels with key levels of support and resistance, with areas of confluence? Next, trend lines. Do you have a trend line that also lines up with where your trade entry is? Do you have a trend line break that signals a trend change? Next, moving averages. Does the moving average line up perfectly with your trade opportunity and area of confluence? Which moving average is it? Certain moving averages work better for specific timeframes. Next, areas of confluence. Are you at an area of confluence? And if so, how many traits are stacked at the area of confluence? The more that are stacked together at the access point means the higher the quality of the area of confluence. Next, candlestick patterns. Do you have a candlestick pattern forming? And if so, what kind? Do you have multiple candlestick patterns stacked together? Is the candlestick pattern forming at a key level? Is there price action inside of the candlestick on the lower time frame? Next, chart patterns. Do you have chart patterns forming? Do you have patterns that show a trend continuation? Do you have patterns that show a trend reversal? Now, chart patterns is a very, very in-depth topic that we'll cover in a future video. Now, a final branch trait that is very important. Support and resistance quality traits. So not all levels of support and resistance are the same, meaning you need to also gauge the quality of an SR level. The higher the quality of the support or resistance level, the higher the probability that price will actually react to the level of support or resistance. This is very key. Now, here are the key traits to look for when gauging the quality of an SR level. First, found on the higher timeframes. SR levels found on the higher timeframes, specifically the monthly and weekly, are the most key levels. Found on means actually visible on the higher timeframes. Second, extreme swing highs or lows, meaning the highest and lowest points prices reached in recent time. Third, multiple reactions, bounces, or reversals from the level. And fourth, recently formed, meaning it was created very close to the left of where price currently is. So to recap, the more traits from this list stacked together on a trade opportunity you are looking at makes it a very high quality trade. There are still a lot of other trade quality traits and concepts we haven't discussed yet, which we will introduce in future videos. So now that you understand the premise of trade quality and Fibonacci, let's combine this all together and move into the strategies section. Now, there are multiple parts to this strategy, but the core of it is a trend trading strategy. So we're going to start simple with combining Fibonacci with key levels of support and resistance using only one time frame. Now, every example we go through, we will do it through the process of identifying and listing high quality traits. This here is where the trade qualities list and counter will appear. This here is where the trade opportunity presented itself. So let's go through the high quality traits that this trade opportunity had. This is the 1 hour time frame. Now, the first high quality trait you had was a key level. So you had it drawn in and extended out. Now, what quality traits does this key level have? Multiple reactions through these 3 reversals and recently formed because the level was created close by directly to the left. The second high quality trait you had was heavy bullish momentum. So this key resistance level previously held 3 times before price finally broke through it, showing the heavy bullish momentum and buying presence, which is required for price to be able to break through such a key level. This then means you want to trade with this heavy bullish momentum and heavy buying presence. And this is where the trade opportunity long presented itself. With the Fib tool, click at the swing low here, drag it up to the recent swing high, and notice how the key level is also right at the 61.8% Fib retracement level, which is a very high quality Fib level. These candles, with the wicks sticking out right at the level, shows a reaction to the level, which then confirms the trade opportunity long. All these traits listed make this a high quality long trade opportunity. So this was just starting simple. Let's now take it up a notch and move into combining Fibonacci with areas of confluence. In this example, we're going to go even deeper and explain what should have been going through your mind at every step of the trade. This here is where the trade opportunity long presented itself. So let's break it down. You first identified that this was a clear uptrend through the higher highs and higher lows. So you want to trade with the moving uptrend. This is a high quality trade. Next, you should have identified your key level of resistance turned to support. This is a very high quality level because price reacted to it multiple times and was recently formed. Another high quality trait. You then would have identified that you had heavy bullish momentum because price broke through this very key level of resistance that previously held multiple times. And again, for price to break such a key level, you needed heavy bullish momentum and buying presence. And knowing this, you want to trade with this bullish momentum. Another high quality trait. As price started pulling back, you would have identified your possible trade opportunity long at the key level of support. Next, you had your moving average that crossed perfectly with the key level and trade opportunity. Another high quality trait. Next, you would have identified that a trend line crossed perfectly with your key level and moving average. Another high quality trait. Then, you would have checked to see if you were at a Fib level as well. Click at the swing low, drag it up to the recent swing high, and perfect. The 50% Fib retracement level also lines up right at the area. Another high quality trait. Now, the fact that the key level, trend line, moving average, and 50% fib level all intersected perfectly makes this an area of confluence, or an area where multiple schools of traders cross and are looking to take action. Another high quality trade. Now look at all the high quality traits that are stacked in this trade opportunity. These are very high quality trades, which means they have a very high chance of success. So this part is very important. Even after all the high quality traits we have identified, as price pulled back and approached this area, you had no idea whether there would be a reaction to the area or not. You needed to wait for price action through candlesticks forming at the area of confluence to show that price and the market is indeed reacting to the area of confluence this time around. And that is exactly what you got. You had these candles with the wicks sticking out right at the area of confluence, which shows a reaction to the area. Now, even after you had candlesticks form and react to the area of confluence, you don't instantly enter a trade long. You need the final two steps, which is 1. The trend change confirmation pattern, and 2. Our key entry and exit strategy and entry tool. We'll cover this as we progress through the video. So, let's show this again. So, this is the Weibo stock. Many of our members took this exact trade because of how picture perfect it was. This here is where the trade opportunity long occurred. So let's break it down. First, we identified that this was a clear moving uptrend as price was making higher highs and higher lows. So you want to trade with the moving trend. This was your first high quality trade. You then had your key level of resistance turn to support. Another high quality trade. You then had your trend line that crossed perfectly with the key level, another high quality trade. You then had your moving average that also crossed with the key level and the trend line, another high quality trade. With the fib tool, you click at the recent swing low here, drag it to the recent swing high, and notice how the 61.8% fib level also lines up with your trade opportunity. Another high quality trade. Now, the trend line, key level, moving average, and fib level all lining up perfectly gives you an area of confluence. As price pulled back to the level, you had a ton of candles that tried over and over and over again to push lower but failed. This all shows a clear reaction to the area of confluence. You then need the final two steps again. So let's do this one more time. This is the Air Canada stock trade our members took. The entry occurred right here, so let's break it down. First, you identified the uptrend, so you want to trade with the trend. Next, you identified the key level here. The moving average then lined up with your key level and is where the trade opportunity presented itself. The trend line also perfectly crosses with your key level and moving average. With the fib tool, click at the swing low here, drag it to the recent swing high. The 61.8% fib area lines up perfectly. This then gave you an area of confluence, making this a high quality long trade opportunity. As price pulled back to the area, you had a perfect long wick candle right at the area of confluence, which shows a reaction to the level. Now, this leads us perfectly into our next topic. So after you had the candlestick react to your area of confluence, you don't enter a trade long instantly and blindly. You need the trend change confirmation pattern. So let's get right into it. Now, before we continue, if you're enjoying this video and want us to release more videos more often, please hit the thumbs up button. And in the comments below, tell us what videos you want us to cover next and any questions you have. Also, go give our Instagram page a follow. This is where the trade opportunity long occurred. You first identified a clear uptrend, so you want to trade with the trend. Next, you had your key level of resistance turn to support. Next, you had heavy bullish momentum because price broke the key level that previously held multiple times. Then, the moving average crossed with your key level and where the trade opportunity long presented itself. With the Fib tool, swing low to swing high, and you have the 50% to 61.8% Fib zone that lines up with your trade opportunity area. This then gave you an area of confluence. When price pulled back to this area, you had a long wick candle right at the level, which shows a reaction to the area of confluence. At this point, you still don't jump into a long trade instantly. This then leads us to the next step required, which is the trend change confirmation pattern. Now, why exactly do you need a trend change confirmation pattern? What we are going to explain right now is very important to understand. Your big picture trend is indeed an uptrend and bullish, but your immediate trend is a downtrend and bearish, meaning there is a conflict in your directional bias. Or to be more specific, the larger trend is telling you to trade long, while the short-term trend is telling you to trade short. The two trends are telling you to trade in two different directions. So what can happen is price can stall at your area of confluence, react to it, and then break through and continue down and trigger a larger trend change. This happens when not enough buyers step in at the area of confluence. Don't forget that this here is a current moving downtrend, which can continue on in its directional path. So how do we get around this problem? You need this short-term downtrend to turn from bearish to bullish so that this short-term trend matches the direction of the big picture trend. Now to do this, you need to look for a trend change pattern inside of this downtrend that shows a change from a downtrend to an uptrend or from bearish to bullish. Or to be more specific, to signal that the short-term downtrend is over and that the larger uptrend can continue. Or to be even more specific, to confirm that enough buyers actually stepped in at the area of confluence. Now there are many trend change confirmation patterns we use, but to keep it simple for now, what you do is you place a trend line onto the immediate trend like this. And if you have a trend line break, this signals a trend change from a downtrend to an uptrend, a change from bearish to bullish, and shows that the short-term downtrend is over and that the larger uptrend can continue. If price doesn't break the trend line and continues down, there's no trade because not enough buyers stepped in at the area, and it's clear the sellers are in control. So after you had that trend change confirmation breakout, all things are a go. This is when you need the final step of the formula, which is to go to the lower intraday timeframes and use our key entry and exit strategy and entry tool. So this leads us to our next topic. What if you cannot place a trend line onto the immediate trend? This is why you need to know how to use multi-timeframes. Knowing how to use multi-timeframes is what separates the amateurs from the pros. So, before we continue, every day we get asked the same two questions. How do we design and edit our YouTube videos? How did we grow our YouTube channel so fast? If you want to learn how to do this all yourself, step by step, head on over to our website at wysetrade.com. The link is also in the description below. So let's start from the top again, except now we'll be combining the usage of multi-timeframes. This is the 8-hour time frame, and this is where the trade opportunity long occurred. First, you identified the key level here. Next, you had heavy bullish momentum because price broke the key level that previously held multiple times. Then, the moving average crossed, which is where the trade opportunity long presented itself. With the Fib tool, swing low to swing high, and the fib zone lines up. This then gave you your area of confluence. When price pulled back to the area, you had a long wick candle with the wick sticking out, showing a reaction to the area of confluence. So in the last section, what we would do is we would put a trend line onto the immediate trend and wait for a break to occur before looking for a trade entry long. Now the issue with doing this on the current trend is that price movement is too tight, meaning you cannot clearly see the swings of price and cannot see the swing highs and swing lows. So if you attempted to place a trend line up close and tight to the trend like this, you will often be faked out by false breakouts. This is a very important point. Price movement won't always be suitable for you to place a trend line, hence why you need to know all the trend change patterns, which we will cover in a future video. But now, for this particular case, how do we get around this problem of not being able to place a trend line? And here's what you need to do. We need to use a lower time frame where we can look inside of this downtrend and be able to see the swings and price movement of this trend, and then be able to look for price action that shows a trend change from a downtrend to an uptrend to confirm that the downtrend is over and that the larger uptrend can continue. So let's pull up the lower time frame, specifically the 4-hour time frame, and put it beside this one. So the chart on the left is the 8-hour time frame we just looked at, meaning every candlestick represents 8 hours of time. The chart on the right is the same asset, but is the 1-hour time frame, meaning every candlestick represents 1 hour of time. Here's the key level on the 8-hour time frame, and here is the same key level on the 1 hour. Here's the 8-hour pullback downtrend, where we tried to place the trend line but couldn't. And here is the same pullback downtrend on the 1-hour time frame. Here is the area of confluence we previously identified and where the long trade opportunity occurred. And here is the same area on the 1-hour time frame. Now on the 8-hour time frame we previously looked at, notice how you couldn't see the swings of price. Whereas on the 1-hour time frame, you can clearly see the swing highs and swing lows and movements of price. Again, we are looking on the 1-hour time frame in this downtrend for price action that signals a trend change from a downtrend to an uptrend. And here it is. On the 1-hour time frame, we can easily place a trend line connecting these swing highs because again, on this time frame, we can actually see the swing highs and swing lows. And once you had the trend line break, this was your trend change confirmation. The 1-hour time frame turned from bearish to bullish and matches the 8-hour time frame big picture bullish directional bias. So one more point as to why a trend change confirmation pattern and using multi-time frames is important. You could have easily had a long wick candle form and stall at the area of confluence on the 8-hour time frame here. But then on the lower time frame, price could have done this instead. Run, pull back, run, pull back. And instead of breaking out and through the trend line, started another run and continued on, triggering a larger trend change. So after you had your trend change confirmation breakout, this is when you need the final step of the formula, which is to go to the lower intraday timeframes and use our key entry and exit strategy and entry tool. So now, the part you've all been waiting for, the massive Bitcoin and crypto trade our members and us took using this exact strategy. This trade used everything we have shown you in this video, and also some more advanced concepts. So let's break this down step by step. This is the Bitcoin monthly time frame, meaning every candlestick represents 1 month of time. As we previously discussed, Things you find on the higher time frames, such as the monthly and weekly, hold more weight. This is a very key point. Because the monthly is slower moving and things take longer to form, as a result, it gives you a very accurate depiction of where the market is headed and of what the market is actually doing. Now, you don't trade on the monthly time frame. You only use it as guidance for trade entries you take on the lower time frames. So there were 3 high-quality traits that gave us our clear bullish directional bias, even before we brought in other timeframes. First, your key monthly resistance level turned to support. Price then broke through this very key monthly resistance level that held 2 times. Next, price was in a clear downtrend before price made a higher high, which shows a clear trend change pattern and a clear moving uptrend. Even before we go down in time frames, everything we just covered tells you one simple thing: look for long trades. Now, this is a very important point. This is what price action is in a nutshell. We were reacting to what we saw the market doing, not guessing where the market would go next. This wasn't even on our radar until we saw the breakout momentum and heavy bullish presence that entered the market, which is then when it entered our watch list. As retail traders, you don't have the power to move the market. You are just reacting to what you see and entering trades in the direction of where the herd and crowd is headed. That's it. So let's pull up the weekly time frame so that we can see this in more detail. So the chart on the left is the Bitcoin monthly time frame we just looked at. And the chart on the right is the Bitcoin weekly time frame, meaning each candlestick represents 1 week of time. This was the monthly key level, and this is the same key level but on the weekly time frame. Here was where the breakout occurred on the monthly. Here is the same breakout area on the weekly. So let's go through the high quality traits on the weekly time frame, full screen. This is where the trade opportunity long occurred, which was at the key monthly level and now also the key weekly level. Again, things you find on the higher time frames hold more weight. So first, you had your very key weekly level. Next, this level that held 3 times previously finally broke through, which shows how much bullish momentum and buying presence had entered the market. Next, we are also in a clear moving uptrend through the higher highs and higher lows. We then had the moving average that crossed perfectly with the key level and is where the trade opportunity long presented itself. Next, with the fib tool, click at the swing low, drag it to the swing high. And notice how the 61.8% fib area also lines up with our trade opportunity. This then gave you your area of confluence. Remember that this is a level that is visible on the monthly and weekly, meaning there is a very high chance that price will react to the level. When price finally hit the area of confluence, you had candles with the wicks sticking out right at the level, which shows a reaction to the area of confluence. So as we previously discussed, we would usually try to place a trend line onto the immediate trend and wait for a break to confirm the trend change. Now, the issue with trying to put a trend line on this current trend is that price movement is too tight and we cannot clearly see the swing highs and lows. So if we were to put a trend line up close and tight like this, it'll result in fake and false breakouts. So again, to get around this problem, we need to use a lower time frame to look inside of this pullback where we can actually see the swing highs and lows of price, and then be able to look for price action that shows a trend change from a downtrend to an uptrend. So let's pull up the daily time frame and put it beside this one. The chart on the left is the Bitcoin weekly time frame we just looked at, and the chart on the right is the Bitcoin daily time frame. Here is the very key monthly and weekly level, and here is the same key level on the daily. Here is the pullback area on the weekly. Here's the same pullback area on the daily. Here is the weekly time frame area of confluence. here's the same area of confluence on the daily. Now on the weekly time frame, notice that you couldn't see the swings of price, whereas on the daily time frame, you can clearly see the swing highs and lows and movements of price. So again, we are looking for price action that signals a trend change from a downtrend to an uptrend. And we got this trend change pattern in two forms. The first is the trendline break. On the daily time frame, we can easily place a trend line onto the immediate trend like this. And then once you had that trend line break, this was your first trend change confirmation. Now, secondly, you also had a higher high, which is another trend change pattern. Run, pull back, run, pull back, run. But notice how this run here failed to make a lower low, but instead made a same low, or a double bottom, which shows a loss of momentum. And this all occurred at the weekly and monthly level. Clear lower highs before price finally broke through the trend line and made a higher high, which is again another trend change pattern. So after you had your trend change confirmation breakout, all things are a go. This is again when you need the final step of the formula, which is to go to the lower intraday timeframes and use our key entry and exit strategy and entry tool. This was a very high quality A+ trade, almost picture perfect. Now there were many different ways our members entered on this trade, some directly through Bitcoin as we showed, and some through positively correlated assets. So now, what exactly is the entry and exit strategy and entry tool? Meaning exactly where to enter trades, exactly where to exit, exactly where to put your stop loss, exactly where to put your profit target, how to manage an open winning position to maximize profits and minimize risk, and all the other high quality traits to look for within a trade opportunity. And a ton of other content that won't be available on our channel as it is too dense. If you want to learn this all, head on over to our website at Wysetrade.com. So in the comments right now, tell us exactly what topics you want us to cover next, and any questions you have. Again, if you want us to continue to release more videos on YouTube, here's how you can show your support. Hit the like button, subscribe, turn on the notifications bell, and more importantly, go follow our Instagram page, as we'll be posting more content over there. Now, we also have a great selection of trading art that shows you the exact chart patterns and candlestick patterns we use. If you want access to these pieces, also head on over to our website. So thanks for watching, and I'll see you in the next episode.